Hi friends, welcome back to the Multifamily Review. I'm your host, Marcus Armstrong. Quick note before we get into it, we are recording this episode on Friday, July 10th, 2026. That date matters. In fact, it might just be the most important date in federal housing policy in a generation. And I'll explain why in about 60 seconds. But first, today we're breaking down the 21st Century Road to Housing Act. What it is, how we got here, and what it actually means for multifamily operators, whether it crosses the finish line or not. And as of the moment, we're pressing record, that answer is still technically open. So, what is this bill? ROAD stands for Renewing Opportunity in the American Dream. That's the Senate version. Formerly, the Road to Housing Act of 2025, introduced by Tim Scott out of South Carolina on August 1st of 2025, came out of the Senate Banking Committee with a 24-0 vote, bipartisan, the committee's first housing markup in over a decade. On the House side, you had the Housing for the 21st Century Act moving through financial services. The two chambers eventually fused them into what became the 21st Century Road to Housing Act. 12 titles, provisions pulled from over 60 pieces of legislation, 36 of them bipartisan. The New York Times called it the most significant housing bill since 1990. NAR called it the most significant housing legislation to pass Congress in nearly 20 years. That's the framing here. Now, let's talk about what it actually does. What's in it for multifamily? Here's the honest answer. It's a net positive, but it's a modest one. And the timeline is years, not months. The most concrete win for our space is the FHA multifamily loan limits. These limits have been frozen since 2003. Yes, I said that correct, 2003. They've been indexing to the wrong benchmark for 2 decades, and this bill fixes that, updating the formula to track actual construction costs rather than general CPI. Housing Wire called it underwriting machinery, not a slogan. Beyond that, NEPA, streamlining for HUD and home-assisted projects, expanded CDBG and home flexibility. The RAD cap lifts by 100,000 units. The bank public welfare investment cap goes from 15% to 20%. For LIHTC deals in high-cost markets, that's meaningful runway. And there's an innovation fund, $200 million a year, rewarding jurisdictions that actually move the needle on permitting and zoning. If you're wondering where to position pipelines over the next 3 years, that fund is going to tell you a lot about which localities are serious. Now, here's what the bill does not do, because this matters just as much. It does not preempt local zoning. It doesn't touch rent control. It doesn't lower your insurance cost, your property taxes, or your labor costs. In fact, Davis-Bacon is completely untouched. The bill originated in banking and financial services committees, and they don't have tax jurisdiction. They don't have labor jurisdiction. So anyone telling you this bill is going to fix the structural cost drivers on new construction is getting ahead of the data. KBW analysts put it cleanly: broad yet incremental supply-oriented housing package. That's the right frame. There's been a lot of questions over Section 901, and I think it's important for us to take the time to go through it just a little bit. Section 901, the headline everybody in single-family rental has been watching, restricts large institutional investors from purchasing existing single-family homes. The threshold is 350 or more homes. If you're above that, you're subject to annual HUD reporting and civil penalties of up to $1 million per violation. But here's what's changed in the final version. The 7-year forced build-to-rent disposal requirement got dropped. That was the provision NMHC and NAA called a direct threat to housing supply. The Urban Institute estimated it could reduce rental units built by at least 72,000 per year. It's gone. What remains protects build-to-rent. Legal analysts have been clear that BTR is now the policy-preferred vehicle in this environment. Multifamily REITs are not directly targeted. Raymond James upgraded Invitation Homes after the disposal rule came out. That tells you where Wall Street landed. Here's the timeline and why today is the date that we care about. The path to this moment is completely worth understanding. In fact, August 2025, Scott introduces the bill. 24-0 in committee. October 2025, Senate tries to attach it to the Defense Authorization Bill. It gets stripped. December of 2025, the House moves its own version. February 2026, House passes theirs 390 to 9. March 2026, the Senate puts the combined bill together, adds the institutional investor language, adds a Federal Reserve CBDC ban through 2030, and passes it 89 to 10. Then the back and forth. The House strips the disposal rule in May. The Senate agrees in June. The final votes 85 to 5, June 22nd. House 358 to 32 on June 23rd. Those are veto-proof margin, and that detail matters. June 24th, President Trump cancels the signing ceremony. His objection isn't substantive. He previously called the most comprehensive and consequential housing legislation in the history of our country. His objection is tactical. He's using the bill as leverage to pressure Congress into passing the Save America Act, a voter ID bill that keeps stalling in the Senate. June 29th, Speaker Johnson formally transmits the bill to the White House, starting the constitutional 10-day clock. That clock expires at midnight tonight. Under Article 1, Section 7 of the Constitution, if the President does nothing and Congress is in session, the bill becomes law without his signature. A pocket veto isn't available here. His only other option is a formal return veto, and given those margins, it would almost certainly be overridden. So as we sit here recording this episode, the most likely outcome is that this bill becomes law sometime tonight. But we don't know that yet, and when you're listening to this, you will. So let's break down the two different scenarios. Scenario 1, it becomes law. If the bill becomes law, which most analysts expect, here's what multifamily operators should be tracking in the next 30 to 90 days. Model the new FHA multifamily loan limits into your capital stack immediately, especially if you're working on high-cost market or LIHTC deals. Do that with one caveat. The Mortgage Bankers Association has flagged a potential drafting error that could temporarily suppress limits below current law until HUD fixes it through rulemaking. Engage your FHA lenders early and watch that space. For build-to-rent operators, the regulatory picture is as favorable as it's ever been in years. New supply models, BTR development, phase takedowns of completed communities are the play. Buying existing single-family stock above the 350 home threshold is where compliance exposure lives. Over the next 3 to 12 months, watch which localities respond to the Innovation Fund and the permitting incentives. That's where you want your pipeline. And keep an eye on Treasury and HUD rulemaking on Section 901. The final definitions of large institutional investor and purchase will determine exactly how tight the single-family restriction actually is. The impacts on rents and cap rates are going to be real, but gradual. BPC's Francis Torres put it plainly. I wouldn't say that as a renter, I would expect my rent to go down the month after this bill passes. The supply equation improves over time, not overnight. So now, scenario 2, what if it gets vetoed? If somehow Trump issues a formal veto tonight, here's what happens next. An override vote would be triggered almost immediately, and given that the Senate was 85 to 5 and the House was 358 to 32, you need 2/3 in each chamber to override. The vote's already there. A veto doesn't kill this bill, it probably just delays it by weeks. But a delay is a delay. The U.S. Conference of Mayors has been direct about what extended inaction costs. America's housing shortfall grows by roughly 2 million additional units over the next 5 years without this legislation moving. That's the backdrop here. Alternative paths exist. Provisions could be attached to the FY 2027 Defense Authorization Bill. Standalone legislation could move, but they all take longer. State and local action continues regardless of what happens in Washington tonight. Because here's the thing about this federal bill that never changes. Zoning authority is local. The federal government is offering incentives and nudges. The actual lever is still at the city council level. A veto doesn't change your market. It probably just delays the tailwind. There's a housing shortage in this country. Estimates range from 3.7 million units on the low end to 4.3 million apartments alone by 2035, per NMHC and NAA research. This bill doesn't directly solve that. It wasn't ever designed to. What it does is remove the friction at the federal level. Things like lending limits, NEPA reviews, capital access, and it incentivizes the local action that actually drives supply. That's meaningful. Whether it became law at midnight on Saturday or it's still working its way through a veto override by the time you hear this, the direction of travel doesn't actually change very much. The federal government, bipartisan and overwhelmingly, just told the country that supply is in fact the answer. Your job is to be positioned where the new supply lands first. Thanks for listening to the Multifamily Review. Be sure to like and subscribe, and I'll see you in the next episode.